Hey everyone, good morning. Welcome to our Zoom coaching session, CCIM analysis for multifamily deals with Helen Chong, CCIM. Today's coaching session is presented by the Merced County Association of Realtors Commercial Committee. My name is Dan Del Real. I'm a real estate agent with Coldwell Banker in Merced, and I have the opportunity to serve as your host for this coaching session. We're super excited to spend some time with you. We've got a lot of great content and a lot of ground to cover today. As you're jumping in, I see the room is starting to fill up. Do us a favor and in the chat box, let us know where you're from. A little bit about the Merced County Association of Realtors Commercial Committee. We're focused on adding value to people by equipping them with the tools and information they need to help them grow their business. One of the ways that we're doing that during this time is by using Zoom. So we'll be hosting Zoom coaching calls on the third Wednesday of every month until September. In September, we're also hosting a one-day CCIM commercial real estate negotiations course in Merced, which you'll hear more about later. If this training brings you any value, plan to be with us again next month and definitely consider signing up for the CCIM training course while you still can. All right, so it looks like Anna is from Merced. Lorraine asked, will this be recorded? This will be recorded. We'll be making it available over the next couple of days. Hello, Jesse from Oakland, Tina from Merced. Looks like Ava's joining us from Beverly Hills. How you doing, Ava? Daria also from, Daria from Atwater, and Mike from Fresno. So looks like people from all over California. Thanks for joining us. I want to say thank you to our partners, the CCIM Institute, CCIM Northern California chapter, Link Strategies, Exceed CE, the Arcadia Association of Realtors, and CREXI. All of our partners have helped support us, and they're helping us bring value to you, and we couldn't do it without them. So this morning, I'm excited to introduce our speaker, Helen Chong, CCIM. Earlier in the year, I reconnected with the CCIM Northern California chapter and was introduced to Helen by Tony Rochelle. Helen moved to the US from Hong Kong by herself in search of the American dream. She managed to graduate from UCLA with a degree in economics while working 3 jobs. She's the founder and CEO of the HAYLEN Group. She's consistently ranked as one of the Bay Area's top producing real estate agents. Helen holds the prestigious designation of being a certified commercial investment member, or CCIM. She's an official Forbes speaker. She's the president of the Northern California chapter of CCIM. She's married, mother of 3 children, and is currently authoring a book. And she's also fluent in 4 languages. I'm excited to welcome Helen. Thank you for taking some time to spend with us today. We're excited to have you here, and we can't wait to hear what you have for us.
Oh, thank you so much, Daniel. I'm very excited to be here. I'm going to go ahead and share screen right now, just so that you guys can see my screen. Are you good? Yeah. Okay, good. So again, thank you so much for being here. I wanted to let you guys know I'm standing up because of my bad back, because I cannot sit down, but it's also much better for me to stand up, just like cold calling, right? You have more energy when you're standing up. So I'm really excited to share this with you. Before we go into this, we're talking about CCIM analysis. We only have 1 hour. You'll see that I'll be speaking quite fast because I'm trying to condense this 4 full days of work into about 45 minutes or so of content. So it's really an overview, and hopefully after this, you guys will be excited about try to take going into taking the CI 101 classes. And I see a couple of people on this call that I recognize. I know they are already CCIMs, and they are still coming back to review some of these deals, and every single person might use this CCIM analysis in a different way. And today I'm going to show you how I use my CCIM analysis to run my numbers with my clients. So let's get started. All right. So I knew what this is usually happens when I start, my clicker doesn't work. So who am I? You see that I have all these destinations behind my name. One of the main reasons is that when I first started in this industry, I was in my late 20s, and I feel like I needed to use education to equip myself when I speak to my clients. I'm just not a salesperson. I feel myself more of a consultant. So that's how I wanted to present myself to my clients. So as Daniel mentioned, I speak 4 languages because I came here from Hong Kong when I was 18-year-old, and my parents actually used to yell at us in 3 different languages within one sentence, and that's how I picked up on all those languages. My professional experience, I used to be a pension consulting analyst when I first started, graduated from college from UCLA, and then I became a mortgage broker. Then I became a real estate rehabber. I started rehabbing homes, and I flipped them. And as soon as I had my first child, I can no longer travel around to flip homes. So I became a trusted note investor. So I was earning about 10, 11.5% interest rate while taking care of babies at home and also run my real estate business. And eventually I was like, I really need I want to build equity. I want a passive income still. I became apartment investor, and I find that, you know, the leverage of these multiple units is so much stronger. And then, as especially after you've realized how the income approach can increase your property value by multiple folds. So that's the reason why I started investing in apartments. And I also became a licensed real estate broker, and I founded HAYLEN Group in 2012. When I actually moved here from LA, from LA to South Bay, which is a Silicon Valley area. As soon as I moved here, I joined Santa Clara County Association of Realtors. I became, I volunteered. The first committee I volunteered was education committee, as you could tell, because I really want to give back, because I earned all these destinations really through associations before. So eventually I became their board of director from 2017 to 2019. And then again, this year, I am the 2020 president for our Northern California chapter. Now, a lot of you might ask, so how do you really do both residential and commercial? My company, we do residential all the way to commercial, but primarily we're focusing a lot on the commercial side is the multifamily. The reason is that we want to help our clients to build their portfolio, build from like finding their home all the way to building their, let's say, apartments, or sometimes they might have their own business and need an industrial office or retail buildings. And that's why not only I'm involved with Santa Clara County Association of Realtors, I start doing research about like what kind of destinations I can earn on the commercial real estate side, so that people know I do understand both sides of the transactions. And that's when I found CCIM. And CCIM destinations, I saw the curriculum. It was very rigorous, but that's what I love, because this is a challenge, right? On top of that, because it's so rigorous, only 10% of the commercial real estate agents have this destination. So this is why I'm very excited. I'm very passionate about our CCIM pin. We all worked really hard to get this. So I hope that I can share a little bit of the CCIM with you today. Now, the journey for me from residential agent to CCIM, it wasn't very quick. There are a lot of destinations out there. You just take 2 hours class and then you get that certification. This one took me about 4 years. By 2009, I got most of my residential destinations. After my second child in 2012, I started looking for the CCIM destinations, and then I started taking the classes in 2013. Then 2014, I had my third child. So as you can see, within 3.5 years, I had 3 babies. So they were all toddlers at the time. So it took me 4 years to finish my CCIM classes. And I finally got pinned on April 4th, 2017. And I can tell you, all my kids called me Helen Chong CCIM. That's how they know my name by. So they know everything about me. Is like, I'm very proud of it. And they have seen how hard I work towards that. And I've been involved with the chapter since 2013. And this year, I'm also been accepted to the JWL Leadership Academy by CCIM. And then again, I'm serving as the president this year. So that's the journey. I know a lot of people can get the destinations. Actually, I don't want to scare you. A lot of people get their destinations in about a year or 2 years, as long as you can qualify for that portfolio requirement. And we'll go into that a little bit later. Now, this is what we're going to go over today, is the differences between residential versus commercial real estate, introduction on the income approach calculation. I'm going to share with you a real investor journey, how they went from residential to commercial, and then also the overview on how I use the CCIM model to analyze those commercial deals so that I could help my clients to move to commercial, and how to become a successful real estate agent in both residential and commercial transactions. But I want to remind everybody that please switch to your computer. If you're on your phone, this may not be the best device to look at all these numbers later on. Oops, let me go back. Now, residential versus commercial. Residential, you know that we kind of sometimes, we excited about residential because the emotion, right? We get their first home, they're so happy, and we are acting more like a counselor at times. But then commercial is all about numbers. So we look at a lot more numbers, and then we make very logical decisions. So with residential, we go drive around, look at different homes, and they get very excited about a home, and that's why they are willing to pay more for a home, sometimes even above the appraised value. Commercial side is that the client look at the numbers, and that's it. If the number works, then they will move. They will continue to do more digging about this property, and then we would probably make an offer, and then we go look at the property. So there's difference between how residential and commercial transaction work. Now, residential is 1 to 4 units, and then once it goes over 5 units and above, these are all considered commercial transactions. And the main difference is that the valuation difference. Residential 1 to 4 units versus 5+ unit is that 1 to 4, we use a approach called comparable sales approach, right? So whatever the competition is sold for, then that's your value, and then add in the condition of your property. But 5+ unit is all about how much money this property is making, which is the net operating income, and also the cap rate. So imagine like 5+ units as investors. Why are they buying this property? They're buying the income stream of this property, and that's why the net operating income is so important. And the cap rate is that cap rate is like a comparison approach, kind of like comparing how is the market doing compared to this property, or how is this property doing compared to the market. So that's why we have a cap rate here. Now, the more money, the more basically net operating income the property make, the higher property value is, obviously, right? And we calculate based on cap rate, and a lot of people get confused what cap rate is. And the way I help myself to understand easily in the beginning is that, okay, I just pretend that if I'm buying this property in the beginning, the first year, what is the return I will earn first year, assuming that I bought this property all cash. So not considering, this is not return, it's not a cash on cash return. It's like, if I bought this property with cash, what kind of return I'm gonna get? So it doesn't take into consideration of the mortgage payments yet. And the nicer the area, or better the tenant profile, or the better class of a property, then of course the cap rate will be lower, so that your property value will be higher. And I've been watching a lot of Bruce Lee stuff. I was just sharing it with Patricia, how I watched the documentary Be Water, and I just fell in love with all the philosophies that Bruce Lee shared. And this is one that I love. It says, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. What I'm trying to share with you, why I'm sharing this with you, is that there are so many different analysis out there that you can use. You just need to find that one and then keep using it over and over again. I found CCIM, and that's the one that I'm using, and I'm going to practice over and over again with this one. And I can tell you that almost, every single client of ours, instead of driving around to look at properties, we just run these analysis with our clients. So let me share with you a case study from how we helped our clients from a condo to over hundreds of units. This is how we build from residential to commercial side. This is a client of mine. I met her 10 years ago. I just had my first child, and he was just born. And she just moved from out of state to Boston, I think, to California, started their family life all over again with a 4-year-old and a 6-year-old. And her husband just started his medical practice as well in California. So they're pretty tight with cash. And so she's just helping out at the clinic. She wanted to start investing though. So this is what we did. First investment property in Yorba Linda. Again, I moved here from Southern California. So that's why our first investment property was in Yorba Linda. It's a condo, $260,000. Rental income was $2,000 per month. 4 years later, appreciated $394,500. Not bad with the rental income. She was pretty happy about it, and she made some money. So she exchanged it into the single family in Anaheim, close to Disneyland, and run it as an Airbnb. Bought it for $575,000. It's a 4-bed, 2-bath. She's getting $7,000 to $10,000 in rental income because of Airbnb. And she loved the rental income, but she hated the restrictions and all these laws that go into it. So she was like, you know what, I'm done with Airbnb. I need to sell it. So we sold it for $740,000. She made pretty good cash flow, and she made pretty good, decent equity as well. Now, after that, I shared with her, like, why don't you just buy multiple units? And this is a 3 unit. She was like, this too much. I never even thought about buying multiple units. So I shared with her this triplex in Santa Monica, and she purchased it for $1.3 million, way more than what she had planned for. But she saw that, oh, well, they were running it, the previous owner was running as an Airbnb and bringing in about $17,000 per month. But because Santa Monica actually they have a lot of restrictions on Airbnb. So after a while, she got really tired of running it again. So she sold it. What's interesting about this one is that we sold it for 2.035. If you use the income at the time to calculate this property, it should be worth about 2.2 to 2.3. But because it's a triplex, again, we have to use sales comparison. So we could only sell it at 2.035, and it's already above the appraised value. So she saw the difficulty and how selling, even though she got really great rental income, she couldn't sell it at the price that she really wanted. So I shared with her about apartments, 5+ units, how that valuation works. So we looked at this 6-plex in Sunnyvale, and after understanding how this income approach works, she was very excited. This is what she bought, $2.37 million property. At the time, purchased at 3% cap. At first, she saw, like, this is insane. Her lender in Southern California saying, like, you're crazy. Why are you buying something with such low cap? The rental income was way below market rate because the seller, she was in her 80s or 90s, so she never really raised rents. So after she bought it, she raised rents to $14,300 per month, and which is a 4.5 cap. It's still not that high. But because of the cap rate in Sunnyvale was about 3 to 3.5%, she actually increased the property value by $1.68 million in just about a year or so. As a matter of fact, I think she bought it for about 3 years. She refinanced, and it was valued at over $4 million. So it's just, I mean, for her, she sees like the equity increase was much higher than what she could have done with like 1 to 4 units. So she went on to 7 units in West San Jose, purchased for 3.3, again 3 cap. But now this time we bought this property that was built as condo, and but then used it as an apartment. At the time when she bought it, it was $600,000 per unit if you're buying a condo. So the value was about $4.8 million. And in 2019, these units actually in this area, kind of close to Cupertino, conservatively, it was about $900,000 per unit. So the valuation is 6.3. So of course, she's very happy that she's gained all this equity, but her cash flow is slow. So when she said she wanted to buy again, I was like, okay, hold on now. You know, I'm working as your consultant here. I've seen you gaining really great equity, but you're not really getting a lot of cash flow. How about we go into some other markets, emerging markets, so they can get more cash flow? She knows that I've been investing out of state, so she came with me to look in Kansas City. We found this property, 77 units in Kansas City, much high cash flow. And look, we purchased this for 3.56. It's 11 times more than what she bought in San Jose for about the same price. Rental income is $43,854 per month. Why we bought this one is Class C property, but we from doing these market research that we understand this area is going to be going up. So what happens when the area is improving? When the area is improving, the cap rate comes down, right? So the advantage for this property is that she's going to buy and hold until the cap rate decrease. Other areas within Kansas City, this metropolitan area, nicer areas is selling at about 6 cap. She's buying it at over 8 cap. So with the 6 cap, that means like assuming the income doesn't increase, just stay the same, her value would be at 5.2. And that's the reason why she bought here in Kansas City. And this is just a few properties that examples that I share with you from her portfolio, that how she went from a condo, she bought it as a condo as a real estate investor, all the way to now she owns hundreds of units and also a commercial property, because she understands the power of this income approach. So I'm gonna share with you now, from this point, I'll share with you guys how I went to do the analysis. So I hope that you guys are on your computer. If you are not good with numbers, you might fall asleep. But if you like numbers, you might have headaches from this information overload. So just prepare yourself. Okay, so how I review a deal from start to finish. Whenever you get a deal, you always ask for offering memorandum. It's almost like a flyer from residential side. The offering memorandum, it looks something like this. It has rent roll, and also it has the financial analysis that they put together. Remember, residential, we do staging to make our client, the buyers emotional. For the commercial side, the listing agent would dress up the numbers to make it more emotional for investors to say like, "Ooh, this is good number." So, but then of course we have to do our own due diligence when we run our numbers as well. So now that I have these numbers, I'm going to run my quick analysis first. I don't go into my 10 years right away because that takes a lot of time. I want to run my quick analysis to see if this even makes sense for me to go into. So I just do a very quick, sometimes it's like a napkin analysis. I put down, okay, asking price $4.1 million, purchase price 3.9, the total monthly income, current, we have current rent, the current rent and also future rent here. So now we see that the total monthly, the annual rent is about $526,248. What you can see is that the average rent per unit here is $526. I'm saying that the future rent from my research is about $610. It looks like it's not that much. It's about barely $80 increase per unit. So, but this is what I want to share with you, is that if you look at calculate the net operating income with a quick analysis, I always like Class C. I already know I would use my 45% expense ratio. That's how I do it. Some other people may not do the same thing, but that's how I do. I would use 45% expense ratio and then calculate what is the estimated net operating income for this property. But if you look at this from increasing not even $80 per unit, you're increasing the net operating income by almost pretty much $20,000. So that's, and then $20,000, some people might say like, it's still not that much. But what happened is that if I use the net operating income 289, and then I know the market cap rate over there is about 7%, then the property of this property is valued at about 4.134. So it is pretty reasonable with their asking price. If I do another calculation, would be like that equivalent to 7.4% cap if I purchase it at $3.9 million. So because my purchasing cap rate is higher than the market cap, I think this is something I can consider and recommend to my client. But what I love about this is that if you see by increasing not even $80 a unit, the value increase by using the new net operating income divided by the cap rate, market cap rate 7%, you increase the property value by about almost $300,000. So that's the power, right, of these income approach. So now the number looks great, and that's why I would recommend this to my client. And then I'm going to run my 10-year analysis. Now, remember, we had this financial analysis from the listing agent, and what I now need to transpose this number into my own analysis. We call it annual property operating data, APOD, which looks like this. So this is something like on this book, we use like all these, we actually, when we take the class, we handwrite all the numbers in there. We do a lot of case studies, and we understand every single cell. I didn't use computer when I first learned this. I actually handwritten all my numbers, used my calculator, and added all the numbers together. So you'll see that on this sheet, of course, we have some property data here, and then we have this assessed value. We have the 25% on land and 75% on improvements. Then I transpose these numbers here. What I want you to pay attention to is that you have to, this is your first part of due diligence. Look at, if you look at the numbers here versus the numbers that the agent had provided, especially the 16,000, the real estate tax, $16,194 compared to mine. They use the current real estate tax, the property tax, but we need to make sure that we're providing the right number for our clients when we run the analysis. So mine is $39,000. That's a huge difference. Another one is that the insurance, they are at a higher insurance, $30,000, but we were able to run our numbers with our insurance broker and they gave us about $20,000. And then the management expenses, they were at $48,000. And then ours is we broke it down into two. It's like one is 19,576, which is based on the management fee, about 5%, and then plus the payroll because you will need an on-site manager. So our numbers adding up is not too far off, but I just want to show you that there is some difference between our numbers and their numbers. And lastly is that if you total everything up, their expense is about $260,000, but our expenses are about $285,000. So that's why it is important. This is our first due diligence to make sure that our numbers, we have run our numbers to see that the numbers that the agent had provided us make sense. Okay. Oh, I want to go back to this sheet. The reason why we're running this sheet is that we are trying to see what we're looking at as soon as we purchase this property and what is the financials going to look like before we even raise rents, because this is based on potential rental income. Is that this income is based on what we will get, like this, the actual numbers that the seller's been getting before we even raise rents or anything else. And then another sheet of this analysis is that we need to put in our assumptions, because without assumptions, you can't really run your 10 years, right? So I know that my clients is at about 35% income tax bracket. The capital gain tax, of course, is 20%, and the straight line recapture is about 25%. And then we have vacancy rate. This area I put down 7% here. Rental income escalators, like every year in the beginning of the year, I see that we can probably raise rents a little bit more, but then on going forward, they've been raising rents just about 4% in that area. So this is why I put down 4% and for the rest of the rest of the years. And then other income escalator, it could be laundry income, it could be parking or storage. So I just put the standard 3% for my own analysis. And the expense escalator, same thing. I just put 3% expenses, assuming that every year there's some expenses increase. And this one, the last part is that we want to do 3 different analysis for our clients. I mean, 3 different numbers is more like aggressive, moderate, and conservative. So we were saying that by the end of 10 years, if our clients want to sell, you can do either 5 years or 10 years. I typically do 10 years because most of our clients like to hold longer. Then it could go from 6.5% cap, 7% cap, or 8% cap. And then we're going to see what is their return IRR is going to look like in the future. Now, before we go into the IRR, we have to run our now 10 years cash flow. Daniel, how's my time go right now?
We're at the half hour, so you're doing great.
Okay, good. Okay, so now I can slow down maybe a little bit. I thought I was running late. So this is the 10 years cash flow that I use, and this is what it looks like. It looks it looks like a lot of numbers. Again, as I mentioned before, this sheet, when we were taking the CI 101 class, I filled this in by pencil. I did not use a computer. Every single cell here, I would add it in myself, because this is how you can understand how it works. And that goes back to what Bruce Lee was saying. You want to practice the same thing 10,000 times. And that was the reason why if you immediately use the computer to generate these, it's not going to make sense. But if you can actually use pencil in every single year, every single cell, now you know how these numbers come from. Okay. So this sheet looks pretty overwhelming, but I'm going to separate it out into different segments. There's mortgage data here. There's this table where it shows our cash flow, because it also included the taxes, how much tax we're expecting to pay. And also you'll see that there's 11th year all the way to the right side. The reason why we have that 11th year is because assuming we own these for 10 years and at the 11th year, you're going to sell it, then you're going to use the 11th year number, right, to put it on your offering memorandum. That's why we have the 11th year number there. And then we also have this cost recovery data. This is the depreciation, because when we calculate your taxable income, we're going to deduct the depreciation of the property. Okay, so now go into detail about the mortgage data. The mortgage data here is where I can run my numbers before I even talk to the lender, saying like, okay, how much loan amount you probably can get from this property based on the numbers that we ran on our annual property operating data sheet, the APOT sheet. So I ran my numbers here. There's this debt service coverage ratio. That service coverage ratio, it means that the debt service is the annual mortgage payment. So your mortgage payment times 12, and then your net operating income here. So how much of this net operating can cover your annual mortgage payment? Because the lender, they want to know, right, can your net operating income sufficiently cover your mortgage payment and still have a little bit more room for some unforeseen expenses? So that's why a lot of times they want the debt service coverage ratio to be at least 1.25. Right now, I've seen that something at 1.15 when the market was really good, but now probably the mortgage lender, they're asking for a little bit more higher numbers, but that's 1.25 is pretty standard. So from when I ran my number based on a 77% loan to value at $3 million, then the debt service coverage ratio is 1.35 based on knowing what is the rate and what is the amortization period and loan terms. We actually got a quote from Freddie Mac loan, and so we were able to get a 30 years amortization and a 10 years fixed for 4.2% interest rate, and they were actually allow us to go all the way up to 80%. So at the end, my client got this property at 80% loan to value, which is really amazing. And then the bottom part here, the cost recovery, is the depreciation. So if you remember on annual the APOT sheet, we had talked about like the assessed value of the property, how many percent is the land, how many percent is the improvement. Remember, one of the advantages to being a real estate investor is that you're allowed to do depreciation, right? So that's why we have this cost recovery data, because we want to know how much depreciation we can take out every year. So for residential, no matter what number of units, you get 27.5 years, while commercial, you divide by 39 years. And this is also why people like to do residential, because you are dividing it much less than the commercial, so you get more depreciation every year. Okay. Nope. Next one. Here we go. Now that giant tables that I had earlier, 10 years, I cut it down into 3 years just so that you guys can see better. So this is what we are trying to look at, is what is the taxable income for this property after all the expenses and the depreciation. So you see that we basically condensed it, and then we have this net operating income, and then every year, of course, it goes. Then we have that increase, remember, because we have the rental income escalator, and then we have the other income escalator. We have the expenses escalator here. Then you have the interest, because you're paying mortgage, so you get to deduct the interest as well, and you get to deduct the depreciation as well. So this is the depreciation schedule that we have. The first year, it was not a full year, that's why it's a different number from the rest. And also we get to amortize the loan fees as well. So this is how we calculate the taxable income. And then based on our clients, if they are at 35%, this is how much tax they're expected to pay. And the cash flow here is the net operating income minus now net operating income does not include the mortgage payment, right? So that's why here, if we want to know the cash flow, then we need to minus the mortgage payment here, which allows to calculate what is the cash flow every year before you pay tax and after you pay tax. I think this is why I love CCIM analysis, is that after I took my CI 101, I learned this. I told you how I used my pencil, hand filled everything, and then I started using my computer to run this for my client. That same client it just blew her mind away. It's like, wow, you even calculated based on the before tax and after tax. It's very rare that any other commercial agents would actually do that for them. Of course, we are not we are not a CPA, we're not a tax preparer. And funny thing is, my client is actually, she's a CPA. So so I can tell her that, like, this is just my estimate, but obviously she should consult with her tax preparer. But this actually gives her some idea what she's going to look into for the next 10 years of her cash flow. And you can run your assumption based on what you think you can do to the property, what kind of value adding you can do. Is it that you can cut expenses, or can you increase rental income? Different things that like that, you can put together your 10 years cash flow for your clients to see what they're looking at. So now you finish this, this table or this sheet, you go into the next sheet is to see what is the value is going to be like by the 10th year when she's going to sell it. What is the sales price going to be? Remember, we talked about we have three different scenarios. I'm sorry, yeah, three different scenarios based on what you can sell at the 11th, based on the net operating income on the 11th year. So the net operating income in the 11th year is $470,000, and divided by the cap rate, which is what we had initially. We talked about, like, we had three scenarios: 6.5% cap, 7 cap, and 8 cap. So that's the numbers that, of course, sometimes you might work with your clients. Your clients like, no, I think the cap rate is going to be this, and you just have to use. Nobody can really predict, right, in the 11th year, but you just have to use your best judgment to come up with the numbers that are agreeable between you and your client. And so using that net operating income divided by the cap rate, these three numbers are the numbers that we think we can sell it at the 11th year. And now we're going to calculate the adjusted basis, because we also need to know at the end if they are going to pay tax, they're not doing 1031 exchange, how much tax they're going to pay, or if they're going to do 1031 exchange, how much cash they're going to get to exchange in another property. So we have to calculate based on their adjusted basis here. They bought the property for, I think it was $4 million plus some fees. That's why the basis at $4 million, and then minus the depreciation that they have taken before. So that's why you have to minus back in, meaning now the basis is lower. So if they sell higher, they have more gains because they had taken the depreciation. Now the capital gain here is that the sales price, assuming we can sell at 7.2, we're using this scenario, 7.2 minus the cost of sale, the commission, the closing costs, etc., and then minus your adjusted basis of your property, of the property value. This is the gain that we calculate by, it's approximate, this is the gain of the property. So minus the straight line cost recovery, this is basically is talking about the capital gain that you had gotten. Then your capital gain from depreciation is about $2.8 million. So using this capital gain, now you can find out how much tax approximately that they will need to pay. So now here we're going to calculate the sales proceeds. At the end of the day, they want to know how much money I can get. The sales price is 7.2 minus the cost of sale again, minus the mortgage balance by that time, by the 10th year. At the end of the 10th year, your sale proceeds, the cash that you actually pocket, is about $4.4 million. But then if you are going to pay tax, you're not doing 1031 exchange anymore, your client said, I'm done, this is it, then you're like, okay, you probably will have to pay about $243,000 worth of the tax on the depreciation recapture, and also the capital gain tax on whatever gain you have made. So the tax that she will have to pay is about, this is going to be $800,000. So a lot of times when clients see that, it's like, oh my God, I have to pay $800,000. Never mind, I'm just going to roll into another property. Now they have $4.4 million worth of cash that they can use to roll into another property. And just imagine if this is like a 20% or 25%, you can roll into a much bigger property in the future. But again, you can use 3 different scenarios here to run the numbers. So let them know, it's like, this is more my aggressive number, this is my moderate number, and this is my conservative number. And clients absolutely love it, because you're not giving them they see that, oh, you're running different scenarios for me, so that you're not over promising me the numbers, right? And then at the end of the day, numbers, what does it mean compared to what kind of return I can get with this compared to stock markets or other stuff. So we use this T-bar on, again, 3 different scenarios just now. This top part is before tax, like assuming if she or he are gonna do 1031 exchange, and this is after tax return, assuming that they will be like, okay, I'm done, I'm gonna pay tax, and what kind of return they're gonna get. So remember in the beginning, she paid about $1.042 million into the property as an initial investment. And then the next 10 years, these are the cash flow that we're expecting. And then the sales proceeds that she's gonna get after they sell the property. And we calculate the IRR is about 24.7%. This is an aggressive model. And if they had paid tax, it would be about 20.73% for this model. Or conservatively, if it's still at 8% cap, then they might get about 22% and 18% after tax. So these numbers, I mean, this looks amazing, these numbers. That's why my clients are like, oh my gosh, I definitely would love to buy this property. But then sometimes like you might see the numbers could be like 8%. And we have clients that are like, as long as it's over 5%, I'm good. Just give me anything that's over 5% IRR. Or we have clients saying, nope, I need something that at least 10%, then we will look at it. And then we have other clients like, well, if I'm buying in this area, I need to have at least 20%. Otherwise, I'm not going to go into it. So this is what, at the end of the day, this is what we want them to see. So all those numbers that we put in the front is for this sheet. And so I always say this is the most important sheet for our clients to look at. Okay. Here we go. Is this how you guys feel right now? Too much information, brain overflow, don't know what happened, don't know what's going on with all these numbers. When I finished my CI 101, 4 full days from 8 all the way to 5 p.m. every day. That's how I felt. Literally every day I had a really bad headache, but it was a good kind of headache because there was so much good information. But it's okay. You know, I know you might say like, now I have a deal I want to do, but this is too much for me to learn. Then refer it out, get a 25%, whatever, 30% referral fee, why not? Or just partner with somebody who has experience on the transaction. I tell all my new agents the same thing. When you first started, you don't know what you're doing, and you are not just selling a cup here or a grocery here. You're selling a property as somebody's investment, somebody's future here. So please be their consultant. I work with somebody who has the experience. And I always say teamwork is the most important thing. You don't want to do things on your own. I would say 90% to 95% of my transactions work with somebody. I don't take a transaction on my own because I truly believe that, talent wins the game, but teamwork and intelligence win championships. I know it seems like, wow, I have to split my commission with somebody 50%. That seems a lot, but that's how you can grow your bases, and then you can continue to get referrals. Not until this year, I just decided I'm going to start to pay for some marketing fees, but my career have been going on with referrals only. So really try to make sure that you provide a quality service to your client, and instead of just focusing on the money. And this is, I just want to share with you a little bit about CCIM. These are our past chapter presidents for recent past years. I'm very proud of this because, as we know, right now we're talking about the diversity in our country. I always say that the racism, injustice doesn't only happen in the United States, it's actually happened all over the world, even where I came from. But I'm so proud of this chapter, why I'm passionate about it, because we are very diverse, from the age group, from gender, from ethnicity, everything. And each one of these people, they are not just leaders in a chapter, but they are leaders in the commercial real estate industry. As example, for example, David Pio, he became our president when he was in his early 30s. And now, after, I don't know how many interviews, and Patricia may know how many interviews, he finally became the CCIM Institute instructor to teach CI 101, the full course. And Mark Hinkins, he's like the president for several different organizations. Steve Peterson, same thing. He does a lot of education workshop. Every single person here, they're just amazing people. So I really want to encourage all of you guys to, if you want to know more about CCIM, join us. Go to norcalccim.com. We have a few different every month we provide a lot of different education programs. We have the virtual mentoring session actually tomorrow, and then we have also next week we're doing another similar class, but with Santa Clara County Associations. It's 2 hours long, so at the end of my presentation we actually go into doing some exercises, and then after that we will have the deals and drinks, which is like a happy hour. So we do networking there, meeting people. And we also have book club. If you like book club, you can join our book club as well. These are the destination courses that you need to take. The CI 101, 102, 103, 104, and also negotiation, which Patricia actually, she'll be speaking a little bit. She teaches negotiation at CI 101. So she can share with you a little bit more about the classes. And after you will have to meet a portfolio requirement, and also after you're qualified with your portfolio as well, plus all these classes, then you can take the 6 hours final exam. It occurs 2 times a year, and I got mine in Chicago, and it was a time where you just meet with all the CCIMs and or the leaderships throughout the world, and there are people coming from Asia, Europe, and it was just like a huge conference. I've been going there for 4 years. I absolutely love it. So with that said, I want to turn this over back to Daniel, and thank you so much for watching this and listening to me. I know it's a lot of information.
Hey, thank you, Helen, for all the information that you shared today. During shelter in place, I've been watching a lot of sports documentaries, so I can appreciate the Bruce Lee and Michael Jordan quotes. We appreciate having you as our guest, and we're looking forward to all the great things that you and CCIM NorCal have to offer for this year. If you'd like to rewatch or share today's coaching session with someone, we're going to be sending out a replay over the next couple of days. We'll include some links to some of those events that Helen talked about in the email, so look for those. And then we're doing these calls on the 3rd Wednesday of every month. So our next call will be on July 15th from at the same time, 10 a.m. to 11. And then we heard Helen talked about how she loves CCIM analysis, and you could see how those skills have dramatically impacted her business and her ability to help her clients. If you'd like to learn more about CCIM and start the journey of getting equipped with some additional tools, we have a great opportunity for you. We're hosting a one-day CCIM course, as Helen mentioned, on commercial real estate negotiations in Merced on September 16th. It's going to be taught by Patricia Lynn, CCIM, who happens to be on the call today, and she's going to tell us a little bit about the upcoming event.
Great. Can you hear me okay?
Yes, we can hear you.
Super. Thanks, Daniel, and thank you, Helen. That was a great presentation. It reminds me of what CCIM does so well that none of the other organizations where you can learn financial analysis do. And that is take the hard part of the numbers, that aspect that you have to practice 10,000 times, and apply real world to it. And Helen, that was a great job of taking the numbers and the analysis and demonstrating how you and your clients have made money as a result of it. And one of the criteria to be an instructor for the Institute is to be full-time successful in the real estate business. So my transition to talking about the Institute a little bit. I've been an instructor there for over 30 years. I've been excited to be able to participate in developing a lot of the courses. I've been course chair of CI 103, CI 104, early on helped to write the first foundations course, which is the basics of the financial analysis. But what I'm the most excited about for CCIM to have brought into their curriculum is the negotiations program. And we brought this in after a long search of many different styles of negotiating all over the world. And we incorporated the Harvard, you may have heard of the book, Getting to Yes. We incorporated the win-win negotiating program, or interest-based negotiating. And we brought that in about 10 years ago or so, and spent the last period of time to create courses. We have an online course. We have the one day that is very small, but we have an online course. We have the one-day course that we're going to be offering in September. And then this is part of your requirement for your CCIM designation. We then build the concepts of the one-day course into CI 103 and 104 with case studies where we carry forth that foundation that you've developed and actually negotiate in our courses. In 104, we actually make presentations using the concepts of the negotiating program. So I'm hugely in favor of this and supportive and so excited about this application of negotiation skills to what used to be just a numbers-based organization. Now, for those of you who don't know about our program, and those of you who already are on the path toward taking courses, the really interesting aspect of this negotiating program that we have is it's not just for real estate. It is interest-based because we are in a relationship building. I teach in China once or twice a year. I've been doing that for about 20 years. And I go over there and I negotiate for chopsticks and shop in the market and love doing that. But that's a one-off transaction. What our program is based on the fact that we will have a relationship that we need to develop and maintain over time. And so this not only applies to the real estate, but you've all been locked up with your families and your children, and have other kinds of negotiations that you are conducting. And you can take our process and apply this anywhere. And I do that and use that every day. So what it looks like is a 3-step process. It is linear. You do step 1, and then which is on the screen, who are the parties, who are the stakeholders, what do they want? You look at step 2, which is now that we know what they want, then what can we do to give them what they want so that everybody gets what they want? And then that third part, which is sometimes called BATNA, or consequence of no agreement. So that's what the program looks like. And I'm looking at, Julie, your question online or in Merced only. It is also, we are working to move this course online as an alternative, but if you can get to Merced, if you are anywhere within 200 miles, I would recommend that you take the live course. It is an opportunity to sit down with people and negotiate directly. It's action-packed. We've got lots of case studies built into it. And so yes, it will be online eventually, but we have this opportunity in Merced coming up soon. How am I doing? Any other questions about this? And have I covered everything you want me to cover, Daniel?
You did a great job. Yeah, thank you for all the information about the upcoming event. We do expect spots to get filled. And so if that's something that interests anyone out there, you can go to ccim.com/CREN, and definitely recommend register and save your spot today before it gets filled up. And thank you. Just want to say thank you again to Helen and Patricia, and to everyone who joined the call today. We're looking forward to seeing you again soon. Stay safe and stay healthy, and we'll see you guys soon.
Oh, Daniel, I think Jesse asked, like, how much is the fee for the course?
Great question. So the course is $295 if you for anyone off the street. If you're a member of the Northern California CCIM chapter or CCIM or the Merced County Association of Realtors, there is a discounted price of $225. Great question.
And that's a great value. Super.
It is. We have held these course before, and everyone came on and they absolutely love it because it really brings your negotiation skill to the next level. Yeah, and thank you so much for having me here.
Thank you, Helen. And one more thing to Patricia's point, the in-person classes are great because you get a chance to meet people. I first met Patricia 15 years ago, and I always bother her with my real estate questions, and she's kind enough to answer them. And you get to meet great people like Helen and Patricia and other people who attend the course. So definitely a lot of value attending in person. And if that is, I think that's it for today. We're coming up on the hour. So thank you again, everybody, and we'll see you guys soon.
Okay,
Thank you.
thanks. Bye.
Bye.